Gentlemen, thank you so much for joining us. And as usual, maybe I'll start with you, Bismarck. What's your call? I think the consensus view is that very little will change today, but as you consider the state of the markets, which have changed dramatically, especially when you look at the fixed income market since the last meeting, what are your expectations?
Well, it's a situation where the yields on 90-day treasury bills are down to 3%, and inflation is at 12%. That negative rate of return is not sustainable. So it's only a question of time. Are you going to use the NPR as a signaling tool to send the market, so send a signal to the markets, or are you going to use the unorthodox methods to bring back rates to where they can actually begin to curb inflation is the issue. So our call is that there's a 30% probability that they will surprise the market and increase rates, but otherwise everything points towards status quo.
As you look at that so-called trilemma for monetary policy decision makers, are you suggesting that inflationary pressure is the real risk right now, or do you think the exchange rate is also something that could move?
I think inflationary pressure is based on two factors. One, the minimum wage effect. Two, the VAT. Three, border closure. And then money supply. So when you look at high-powered money, look at border closure, which is food inflation, look at minimum wage and the arrears, and then look at the VAT effect, which will kick in February. Definitely, inflation expectations are that we'll be looking at 13 to almost 13.5% in February. And if yields are at 3%, that window, that gap is too much. Something has to happen.
And before I come to you guys, just wanted to get your thoughts, because you've been watching the markets for a long time, and I know this is not the first time we're seeing negative interest rates, but typically what happens after this cycle? How do you see things adjusting from here?
No, this is not just negative interest rates on T-bills, but also on money market instruments. So you're having banks offering 1%.
So are you saying this is unprecedented?
This is unprecedented. It's not, and it's unusual. What happens is basically is that since savings is a function of interest rates, the marginal propensity to save will decline, the marginal propensity to consume will increase, the propensity for capital flight will increase. So the pressure on the external sector is what we have to worry about. How it's going to manifest itself is a different story.
All right, Guy, what's your take overall?
I think if you look at what's coming out of the CBN, the word you get is heterodox. We are having a heterodox economic policy, heterodox monetary policy. Now, I think they're likely to hold rates at 13.5%. And the reason I think that is so far so good. Heterodox policies are working so far. Later on, as Bismarck says, you have a T-bill rate at 3%. You have inflation pushing 12%. I think it could push a bit higher than that going down the line. You have a CBN bills, the central bank's own bills, are yielding 13.2%, a huge contradiction between T-bills yielding 3%. And federal government of Nigeria sovereign Eurobonds are yielding 5.5%, which is a whole lot more than domestic T-bills at 3%.
That's an interesting point, because the dollar-based borrowing is actually yielding higher than local borrowing.
So, these heterodox policies will unwind at some point. Now, I think the question is, do they unwind suddenly, or is it going to be a 6 month to a year process? Based on what we're seeing in the market so far this year, quite optimistic. I think it's more like a 6 month to a year process. I don't see any big foreign exchange shock, touch wood, oil price shock to make the whole thing collapse quickly.
Right.
But also, the central bank said that inflation rate higher than 12% is growth retarding. They've made that statement consistently.
So there's been some guidance around.
So 11.98.
Where we could see some
once you go, then
movement.
you need to do something. You need to react. So I think we need to understand that we don't have a 6 month window. I think you have more like 1 quarter, that is Q1. After Q1, everything changes.
All right, Roy, let's come to you. Obviously, you're watching from over there. And Guy made this point about the heterodox policy that has been really unraveling over the last few months. And overall, how do you view the investment opportunity in Nigeria as a foreign investor?
I think we must sort of reflect a bit to the last time we all sat together and discussed MPC, where we focused a lot on the concerns around growth and less concerned about inflation. And it's interesting now how we've switched to last MPC thinking there was a slimmest of chances of a cut to the slimmest of chances of a hike this time around. So yes, we are focusing on inflation, and I share Bismarck's concern at the 12% level. But we're not overly concerned just yet. I mean, I think the growth rate is still okay for Nigeria to get by on. Yes, we got this big sort of difference and sort of unusual behavior between the T-bills and the OMOs. Again, you know, for clarity, the OMOs are now available to non-residents, and the local residents were forced out of the OMO market, and they could only then use surplus cash into T-bills. That then drove those T-bill yields so much lower. I do believe that will correct over time. But again, the OMO rate remains high, and I think it remains high for specific reasons, and that's to attract offshore investment. We're still seeing a lot of offshore flow into the market. In fact, if we look at the flows over the past week, there's probably been about $1 billion of flow into the Nigerian OMO market, and some of those will be rollovers and maturities, and some of it will be dollars coming back into the system, which I think is one of the key drivers, is to attract some dollar investment from offshore. So everything's for us, where we're sitting, you know, no change to the policy rate. We'll see the OMO rate staying probably as high as it is. We expect the T-bill rates to then start pulling back a little bit towards OMO rates, and we continue to see offshore investors into the FDI markets.
Right. Let me come back to the point you just made about $1 billion flowing into the OMO market from offshore. And that suggests confidence. So what potentially is the risk that you're assessing when you're looking at Nigeria? Typically, there is always concern around the oil price. When that begins to slide, there is concern. But is there anything else out there that is giving you cause for concern?
So let me clarify on the point that I mentioned, was to say that $1 billion worth of OMO bills were bought. Some of those were rollovers, and some of it was new money coming into the OMO market. The concerns from an offshore point of view are low. The traction from an offshore point of view remains the yield. Yield is good when we consider currency stable, steady yield on the OMO markets. Guys are happy with that, so they're going to keep putting money, and they're going to keep putting into the short end of the curve after 12 months. Not many people are putting money into the longer end of the curve. They keep in the short end of the curve. The biggest challenge to that investment into Nigeria is probably the Egyptian market. We've seen yields come off quite a lot as well over the course of the last 6 months. There's some flow that will possibly leave Nigeria and head into Egypt, but that's kind of those are just yield plays. Those guys are chasing short end of the curves, looking for some positive carry on cash, and most importantly, a steady currency. On the currency side, we can debate, is the currency at a right level? Should it be slightly weaker? Is there room to allow the currency to weaken slightly? That's another discussion we can have. For now, on the interest rate side, everything is looking good, and we're still going to see that offshore flow into the local market.
All right. I'm told we have to go to Abuja shortly, but very quickly, if I can just get your thoughts on the point he just spoke to, the currency. What really, in your view, should be the value of the currency right now? Because most people I speak to in the market are suggesting that it's only a matter of time for us to see some currency weakness. But of course, the central bank continues to assure that the risk of that is low.
What the central bank says is that it's only when the reserves get past a particular level that they begin to worry.
I think the number is 30 billion.
30 billion. So there's still some room for that. But are you going to wait for it to get to 30, or are you going to make a move before it starts moving?
Let me ask you the question about the valuation, so to speak, of the currency. Do you think it's ideal?
I think
very quickly, because I think
that restructuring the foreign exchange market will precede a change in the value of the currency, going to a crawling peg. So there's work to be done, a structural change before an operational change. So I think, and that's not going to happen immediately, because there are some things that need to be done.
Quick word on that point as well. I have to go to Abuja.
I mean, I agree. We would love to see a crawling peg. That would be fantastic. If you hold the currency at close to 362.5 for a year, that's fine, but then you're mounting up the pressure, you're building the pressure going into 2021. So this pressure to adjust rates, never goes away.